righty, everybody, we'll get going here. Again, my name's AJ Bialik. I'm a real estate advisor here at Marshall Reddick Real Estate. This is our 1031 exchange webinar. We're going to talk about how to sell without having to pay Uncle Sam your taxes by utilizing a 1031 tax deferred exchange. Again, my name's AJ Bialik. I'm a licensed realtor and I'm a real estate advisor here at Marshall Reddick. I have a Bachelor of the Arts degree from Concordia University. I have a background in commercial real estate. I started working in real estate back in 2015, so I'm coming up on my 9th year now, and actually my 8th year and then my 9th next year. I had a coaching background and exercise and sports science background coming out of college, got into commercial real estate, worked in commercial for about 3 years, and I've been in residential now for the last 5. I'm intimately familiar with all of our Marshall Reddick locations, especially in California, Texas, Tennessee, Kentucky, and Florida. And I'm an active real estate investor myself. My family has a small portfolio of homes out of state, but I'm also an active Marshall Reddick Mortgage Fund capital partner, which is basically just the best savings account you could ever have. So who is Marshall Reddick? Number one, we are a real estate brokerage. We help people buy and sell real estate. We help investors buy and sell real estate. We help investors utilize 1031 exchanges. We're a property manager, so we help our investors who purchase real estate manage their property. We are a private lender, so not only do we lend money to people, to fix and flippers and investors, we also allow people to we lend money out to those investors, and we also have a mortgage fund where we can allow those same investors to invest in a giant pool of 300 separate mortgages that are all non-owner occupied first trust deed mortgages, and they'll pay the investors in the capital fund a yield percentage back, and basically you're getting free cash flow while building your savings. Our investment methodology, it all starts with you and your goals. So we're going to start with your why, your goal setting. Then we're going to go into how are you going to be able to make this purchase happen? Do you have to sell something? Do you have to liquidate something? Do you have to get pre-approved? When do you want to do this? What is your criteria? Where do you want to be to achieve those goals? And then who do I need to introduce you to make it all happen? So this is our Marshall Reddick wheel, but it all starts with you and your why. And why do you want to own an investment property? Why do you want to have cash flow? Why do you want to have appreciation? It all starts with you and what your goals are, and that's where our first consultation will always start at Marshall Reddick. These are the markets that we're in at Marshall Reddick. So in California, we're here in Orange County, Riverside, Los Angeles, and the Bay Area. As we drop down into Texas, we're in New Braunfels, San Antonio, Austin, Houston. In Tennessee, we're in Nashville, and then outside of Nashville, there's a really small little booming market called Clarksville, Tennessee, which borders to Oak Grove, Kentucky, and we're also in Southwest Florida, in Lehigh Acres, Cape Coral area, along the Gulf there in Florida as well. So in all these areas, we have boots on the ground, property management, and brick and mortar offices in those locations where we can help manage all of our assets for our clients that are owning investment property in those locations. And why do we choose those specific markets? Well, first off, we look at the job market, we look at the historical vacancy rate, we look at the economic diversity, housing affordability, is it landlord friendly? You know, California has probably a great job market, not that high of a vacancy rate, a lot of economic diversity. We definitely don't have housing affordability, but are we landlord friendly? No, we're not. We're actually one of the hardest states to be a landlord in. So a lot of our clients have been 1031 exchanging, selling their assets in California, cashing out while the market's insanely high, and diversifying into other states that are more landlord friendly, where you don't have to deal with the 180-day eviction process. Obviously, strong education. If we're just outside of a major metropolitan area, where there's great suburbs and there's also a university, I mean, that's a win right there. You have great education, good job growth, you know, a lot of good renters around town. And then reliable property management. That's probably the most key thing. You know, being that we have brick and mortar offices in those markets now. We have our own property management in those markets, and that's really what has changed the game for our service we get to provide a lot of our investors, is that we actually manage properties in those specific markets so that our advisor, our agent, our investor, our property manager, everyone is talking to each other seamlessly and utilizing technology to make sure that your experience as the investor is as seamless as possible. Here's a 1031 exchange example that I did last year for a client. Her name was Sharon. She owned 6 Point Vicente here in Laguna Niguel. She bought the property on May 15th in 2018. We managed the property. Rent started out at $3,000 a month. We were able to grow the rents up to $4,000 a month, and the tenant was leaving. She had a bunch of work she needed to do to the property. She decided, hey, we could probably sell this for $950. I can get a ton of equity out of the home. She bought it all cash for $650 and basically made $300,000. Realized $4,000 a month was probably the maximum she was going to get on that home for a long-term tenant. And we 1031 exchange it into one of these brand new Emma Drive duplexes. She actually ended up buying 2 of them. And basically, she took out a small loan, purchased both of these, and tripled her cash flow. Each property doubled her cash flow. Each unit is $1,800 a month. She has 4 of these units now, so she's making over $7,000 a month, where before she was only going to make about $4,000 a month with that one specific property. So that's just an example of a 1031 exchange that I helped a client utilize so that she could double her cash flow, didn't have to pay any taxes on the capital that she was exchanging, and made it all happen and made it as seamless as possible. Here's a brand new duplex in Buda, Texas that we have available with a builder that we work a lot with. These duplexes are a rare opportunity because if you need to get financing for the purchase and you're using Reed Hazard, who is our preferred lender, you're able to get these financing options, which we'll cover in a moment. But with those financing options, if you have a interest rate of 5.25%, which is what you can get by getting pre-qualified with Reed and his team with this specific builder for this specific product, you're going to be cash flowing $566 a month. And that's on your fixed expenses every single month. And that's with 30% down. So it's a brand new property. You're going to be getting all the builder warranties. You're going to be getting free 6 months of property management. We're going to be managing the property for you, and you're going to be starting off with some great cash flow on some brand new product in Texas, which is pretty unheard of right now in this market. Market rates right now are about 7.25, maybe 6.75 if you buy down a couple points. So if you do get pre-qualified with Reed Hazard and his team, they are going to be able to get you. We have 2 options here. So option 1, 4.25%, buyer pays down 1.7 points. You get 6 months of free property management, seller paid closing costs. And option 2 is 4.75%. You only pay 0.23% of points paid. You get 6 months of free property management with seller paid closing costs. So those are the 2 options right now in Texas with this specific builder. That's with Reed Hazard and his team at CMG Financial, who are our preferred lender. And if you need his info, feel free to reach out to me and I can get that to you. All right, so now we're getting down to the meat and potatoes of everything. I'm going to introduce Erin Crowley. Erin works with Asset Preservation Management. She does all of our 1031 exchanges for all of our clients, and she's done zillions of these. So every single time I'm a part of one of these webinars, I end up learning something brand new about 1031 exchange. So I'll give it up to Erin and let her take the floor here.
Well, thank you. I have been doing them for a long time, and kudos to Marshall Reddick, because the clients that I've been working with of yours, they did well on their properties, and they're getting into some new properties, and they're all very excited about it. So if somebody's doing an exchange, that means they made money, so it's always a good thing. So I'm going to go through this fairly quickly. And I know I can make this work. Okay. And I guess we may have time for questions, but I'm just going to walk through it, showing you how, there's lots of other taxes you may have to pay, but capital gain taxes are something that the code allows us to defer. And it's really exciting when you can see with AJ's help how quickly you can build a portfolio, how quickly you can get income coming in, and it's pretty exciting stuff. So the capital gain taxes, we've got a lot of our clients, when they're selling an investment property, they kind of forget about all the tax levels. And there's actually 4 main levels. You've got depreciation recapture that you've been taking advantage of all these years. So it's a good thing. You get to write it off every year. But when you sell that property, you've got to recapture that. You've got to kind of pay it all back. And it's taxed at 25%, which is the highest level of taxes, thankfully. The remaining capital gain, the appreciation that you've made on your property, is taxed at either 15% for most of us, 20% if you're in the high earners. The high earners are over $580,000 if you're married, somewhere like $550 if you're single. And then the net investment income tax, that one sneaks up on a lot of us. That one is on any of your non-income, non-W-2 income, and it's at 3.8. If you're single, it's over 200 is the threshold. Married, it's 250. And then state taxes, they go everywhere from the Texas ones, which have no state tax, to California, and you guys have a bit of tax there. And New York has, I believe, the highest rate. I'll get this to move there we go. So back in, I won't bore you with too many details, but see if we can get rid of that. But back in 1921 is when this came into the code, and it was really put there so that you could keep growing your portfolio as real estate, but it was really put there for your agriculture. So the ranchers who were good ranchers and they wanted to buy the bigger, better ranch next door could exchange into that one. And if they had to pay the taxes, they would never be able to improve their lot. You may be able to improve their farm or their factory or the manufacturing company or any of those things. So the IRS put this in the code that says that, hey, as long as you're just reinvesting in yourself and your portfolio and your generational wealth, whatever you're building, as long as you're reinvesting and you don't put money in your pocket, we're going to not see that gain. We're going to defer it. We're going to not recognize it yet. And as long as you follow these rules, we're going to let you just keep pushing it along. So that's the beauty of it. And the exchange code is pretty simple. No gain and loss recognized in exchange of real property. We have to emphasize real property because it used to be more personal property and real property, but now it's mostly just real property. And it's got to be held for productive use in a trade or business, which is easy. That's your salon or your factory or your farm or your ranch or your real estate office, any of those things are trade or business. Or for investment, and that's where you all come in. Something that's changed, these are properties held for investment. These aren't your personal homes, these aren't your second homes, these are homes that are actively making you money that you're working on. So these are investment properties. As long as such real estate is exchanged solely for real property of like kind, so we're going to talk about that, held for productive use in a trade or business or for investment. So it's a pretty simple little rule here. Doesn't go into a whole lot of details. That's where all the changes and the rev procs and everything come afterwards. But this, again, is over 100 years old that it's been in our system. Go back. This thing turns quickly, doesn't it, AJ? Okay, so just real quick cap. I mean, the main thing that the 1031 allows you to do is defer that income. And the reason you want to defer it is so you can use it. Instead of paying that tax money and sending it to the IRS, you can actually take it to your lender, take it to Reed and his group, and leverage it, use it for leverage. So the ability to do an exchange is the ability to make wealth accumulate faster by being able to preserve the equity that you've built up in that property and use that cash that you would have paid to the taxes, use that for yourself. 75%, 25% loan to value, take it to the bank, leverage it, get a bigger, better producing properties, or maybe 2 properties. So it's one of the few sections of the code that actually works for the taxpayer allows us to benefit from our own hard work and keep building our equity for our next generation. So that's kind of the goal in it. One of the things that AJ kind of touched upon is diversification. You can go from your property in California that you're really kind of tapped out on as far as as much as you can go in rentals, and go somewhere else. Go to Texas, go to Tennessee, go to these new emerging markets that are really exciting, and start over, ride that appreciation train back up again. So the beauty of an exchange is you can diversify geographically. So you can go from one state to another state. You got to keep it within the United States, but you can go all over. So that's kind of fun. And you know, when you're tired of Tennessee, they can go to Texas. You can go from a high tax state to a low tax state. So it gives you the ability to keep diversifying that portfolio. You can also go by asset class. So maybe you've owned land somewhere and it's valued out and it's doing well, it's appreciated. That's a great time to take your land and buy something that's going to give you a cash flow. Maybe it's you know, a piece of farmland that you've had passed down from the family or something like that. So you can take land and go into a condo. You can take a condo and go into apartment building. You can take your apartment building and buy residential. You can go from commercial to residential, residential to commercial, back and forth to land. So that's kind of exciting thing about it. And I would say the holy grail is to start with land or a single family, then your duplex and your fourplex and your apartment, and pretty soon you're buying them all over the country. So you get a lot of diversification that way. You can also do some management. I don't think I have it in there, but you can also, when you've accumulated a lot, you might have a whole bunch of properties in one state, and you just want to buy one really good producing one, you know, like those properties that AJ showed you in Texas, a couple really good producing ones, and make it easier to manage and have a management company and just, you know, not have to worry about things at night. So those are some of the benefits of it. And estate planning is great because we still have what we call a stepped up in basis, which means that you're going to be building and building and building your portfolio. And then when you pass, it's going to go to your heirs at a step up in basis. So all that gain that you've created over these years basically go away for your heirs, and they don't have to be, they don't need to be paying taxes those capital gains. So most of our clients will just continue and continue and continue to exchange. I guess there are some cons. There's some really strict time rules. Everybody hates the 45 days and the 180, and I'll go through that. You're basically, every time you do an exchange, you're deferring that gain into the next property. So it's following you. It's not going away. It's following you. So if you've exchanged several times, you've got a big chunk of gain. So you want to keep reinvesting, keep reinvesting. The lack of liquidity, so you've got to go out and buy property. You know, it's always frustrating to go and sell a property and not be able to walk away with any cash, but you're walking away with another asset, which is great. Recognizing losses. Luckily, we haven't seen that yet, but you do want to recognize losses. You don't want to do an exchange. And we never really know what the tax rates are going to be in the future. We've got proposals out there right now, but we're not expecting them to have a lot of traction. Just don't know anything at this point until we know what the election is going to bring. So no opining on what's going to happen. And again, it's deferred. It doesn't go away. It's not an exclusion. It's a deferral. And so that is important, that you realize that you're deferring it from one property into the other. But most of my clients are going to continue to do that. So the base requirements, you want to get it. We want to make sure that you talk to a QI, to someone like me, when you get a contract on that property, because there's certain language that you want to keep in that, so that we can get in and do our job, which is to keep you out of the loop of the money, but make sure that all the paperwork is done so you've got a proper exchange. We also want to talk with you and make sure that the entities all line up. So if you've got an LLC on one side, you can't go into buying a corporation, or if you've got a single member LLC, you can't just all of a sudden go into a partnership. So there's ways that we've got to kind of keep everything kind of on the same tax paying level, so we make sure that we set up the exchange for the correct entity. And then, you know, that's where your realtors like AJ come in to help you find that like kind property and find it quickly, because 180 days total. It's not very long, but the first 45, that's the critical time. You're buying up. A lot of people think you're just rolling the proceeds, but you're not. You're basically replacing the value of the property you just sold with a property of equal to or greater than value. So if you sell for 800, you can pull out commissions and title fees and my fee, but those are it. You're basically looking to buy property or properties. You can go from one to many properties and really increase your portfolio quickly. So you've got that timeline. You've got 45 calendar days. I think I talk about it a little bit later. 45 calendar days for a total of 180 calendar days. And identification, it'd be nice if you could identify a whole bunch of properties and make it easy on you. But of course, there's going to be limitations. So I'm going to go through those in a minute here. So the first one that I want you all to remember is constructive receipt. You can't touch the money. And in these day and age, nobody touches money anymore. But what they're really saying is you can't sign on the bottom line on your HUD statement as you, the seller, because that means that you just have you now have money. You have it in your hand. So constructive receipt is where we assign onto that contract. We kind of take away the receipt. We take away the right to the seller to have those funds, put it in an account set up for the sellers, and then when you know what you're buying, we assign onto that contract at closing, and we use those funds to buy it. So we literally take away the rights to those funds so that everything can go smoothly, and it's an exchange rather than a sale and a repurchase. So on the other thing I just mentioned, we want to make sure we keep everything the same. So we're always looking for your tax-paying entity. So those of you who have LLCs or partnerships or corporations or trusts, my job is to kind of work through and make sure that even though it says that it's in an LLC, who is that LLC? Are you in a community property state like Texas and California? Or are you like in Colorado or somewhere else where it's a non-community property state? Those are the things that we want to get figured out before closing. So that's why we want to know if you're thinking about doing an exchange, talk to Marshall Reddick. They'll get you in touch with me, and we can figure out all these things before you go into contract, before you list, whenever it's appropriate time. So that's what we're doing, is making sure that everything lines up. That's our job, to make sure everything property. So like-kind property isn't what it sounds like. It's not, if I have a condo, I've got to find a condo. If I sell in California, I got to buy in California. What it means is if this property is a rental for you, it's an investment property because you're showing on your taxes, it's Schedule E, you're writing off depreciation, it's an investment property. And so other investment properties can be that a house, you can go to land, you can go to commercial, you can go to a ranch, you can buy vineyard. There's all sorts of things. So you may have something that's not really producing for you right now, and you can exchange that into another cash flow property. So like-kind is kind of the most fun part of it because it can be many different things. So I kind of went over that. So things that don't qualify: primary residences and second homes. Those are things that don't qualify. So when you sell your primary home, you have what we call a primary home exclusion. If you're single, you have 250. If you're married, a couple has 500. You have to have lived there for the last two out of the last 5 years. But you get that, and that's just kind of an automatic. You don't have to buy anything. You don't have to do anything. So that's kind of the fun part about that. And second home, so something that you own, a residence that could be rented and you're not renting it out. Maybe you've got a child living there going to school. Maybe you've got it's just something up by the lake or in the mountains that you're just using for friends and family. That, if you're just using friends and family, is a lovely second home, but the IRS does not let you defer the taxes on it. Okay, so there are ways to convert your second home into an investment property by having a couple years of steady rental history showing it on your taxes. So that's one thing that you can change. Same with your primary. You can move out, you can start renting it, but they want to see a track record, and it's usually a 2-year track record if they want to go back and see how have you treated this property, has it shown up on your taxes. So that's what we're always looking for, is how have you shown this. The property is intended for resale, so if you're out there just fixing and flipping properties, that's not going to qualify. If you're a dealer, if you're Ryder Home or Shea Homes or something, and you are just building spec homes, those aren't going to qualify. If you're converting condos or subdividing property, not going to qualify. We want it to be held for investment. And again, it's usually a 2-year or at least a year sort of thing, but it's also very subjective. So we'll talk about that. Partnership interest. If you are in a partnership and you want to do something different than your partners, that's when you want to call me and talk to me, because if you want to do an exchange and you're in a partnership, you own partnership interest in that property. You don't actually have fee simple interest in that property. So we've got to change the vesting and get you fee simple property well before any exchange, well before. So that's something you want to talk to me about if you've got partnership interest. But in an investment property, we got to look at the intent. Why did you buy it? How did you hold it? How did you treat this property is really what the IRS is looking for. A lot of us these days have lock-offs and ADUs and Airbnbs and renting out a carriage house and all sorts of different things, or even a ranch or a duplex or a fourplex. So a lot of us have properties that are both our primary home and an investment property. And these properties, we get to use our residence, our primary home on part of it, and we get to also do an exchange. So in some of these areas where we have a lot of appreciation, we might need both that 121 exclusion and our 1031 ability to defer, just to mitigate and to defer all those taxes. So sometimes, depending on what your property is like, we can actually use both of these, and we call that a split treatment. And it's a very valuable property. And again, you'll see it when folks have an ADU or something, or duplex or something in addition to their primary home. So a lot of folks are going, what do I need to reinvest? If I want to defer all of my taxes, that sounds like a great idea. How much do I have to buy? What do I have to spend? Do I get to take any money, put it in my pocket? The real truth is, unless you're doing a split treatment where you've got a primary home factor in it and you have your exclusion, in an exchange, a full exchange, you're not putting any money in your pocket. You're paying off your commissions, you're paying all those expenses. That's fine, but money's not going in your pocket. If it does, it's going to be exposed to taxes. And we call that exposure, we call that boot. And boot is the amount that the IRS can tax. I don't know how much it's going to tax. It all depends on your tax picture, but it is what is exposed. So we have what we call the exchange equation. Exchange equation is the basic rules for 1031. It's very easy to think, hey, I put 200,000 into that. Why can't I pull that money back out, put it in my pocket, and go my merry way? The IRS thinks it's differently. They're going to just look at the dollars differently, and they've got a very simple equation for full tax deferral. And that is just take all the cash you're going to walk away with. You've got your settlement statement. You look on the bottom, it says cash due to seller. Basically, that's the amount of money that has to go into the next property or properties. You can buy one property, or as AJ pointed out, you can buy 2 properties, you can buy 4 of those. You can buy as many properties as you basically need to get full tax deferral, or more. But we've got to follow the rules. So reinvest all the net cash proceeds. And that debt right here, they had $300,000 worth of debt. In order to defer that amount and not have tax exposure on it, we've got to go out and get another mortgage, or replace that with cash on hand. So basically, if I sell a property for $900,000, I've got to take all of my equity, that $540,000, and that debt that I released, and I'm out there. Let me see if I've got it in the next one. I'm out there looking for a property of $840,000. That's kind of my baseline for a full tax deferral. But if I go out and find a property for $800,000, I'm exposed to that 40, just that gap, that little difference between them. And if I go out and I find something for $900,000 and I use all my cash, then I get to defer everything. But just because you might want to pull some money out, maybe you've got some expenses or you've got a trip you want to take or college education, that's fine. You can certainly do a partial exchange, which is pull some money out, pay taxes on that, take the remainder and do a deferral. So that's perfectly fine to do too. But this one, again, if I sell for $900, the cost of sales is commission, title fees, attorney fees, those can come off of there. And I'm basically looking for a property in that 840 or higher, okay? This scenario gives us no boot. We don't have any, we're pushing it all in. But every now and then, as I just said, you might want to go down in price. You might want to be downsizing. Maybe you're retiring and you don't need all this property and you want a smaller, easier to care for. You can, this is where you can have some boot. And when I see this, when I see somebody who's got like 140,000 of extra that's not being reinvested, then I've got to find out if that makes sense. I've got to find out what their gain is. If that's less than their gain, great. Then they're deferring some and paying some. But in this situation, when we're buying down and we're getting a lower mortgage and we're putting cash in our pocket, that's when we're going to have tax exposure. And again, I can't say if it's a good or bad thing, because you might have $800,000 gain on that property, and paying on 140 is not a big deal. So, talk to me and we can talk about full deferral and partial deferral. The last one is just, sometimes you think that if you can just take your money, your property, and you buy a more expensive property or group of properties, that's going to be enough to give you full deferral, but you have to follow those rules. And the first rule is take all the cash into the next property. Then you can, so in this situation, they still have exposure of 140,000, because even though they spent $1 million, they bought more, they put cash in their pocket, and that cash in the pocket will always be exposed to taxes. So just keep that in mind. So it's not enough to buy more. You want to make sure you use that cash. Closing costs, like I said, commissions, title fees, escrow fees, legal fees, those can come off of what you have to reinvest. But then after that, that's the value that you want to go that or more. And in an exchange, the basis of your property, normally the basis is what you pay for a property, and that's kind of starts where you are, and then you add improvements and you take away depreciation. But when we're doing an exchange, that gain that you just deferred from one property actually goes into the next property or properties and lowers that basis. So each time you do an exchange, your basis is getting lower, which means your gain is getting higher. So that's why you want to pretty much continue to exchange. If exchanges don't work for you, if you're planning on reselling and putting money in your pocket, then they're probably not the best option. But if you plan on building a portfolio of real estate, they're a great option for you. So formats, there's two-party trades where we're just swapping. But other than just swapping across the table with the same person, every time you do an exchange, you have to have a QI in place, and you have to have that exchange document in place prior to closing. You cannot close and then decide to do an exchange afterwards. That's just not going to work. You've got to have all the paperwork in place. That's why when you go into contract, that's when you want to get it set up. So remember, it's got to be in place prior to closing, and you've got to have a QI involved. Multiple property exchange means, just like we talked, you can go sell one and buy five, you can sell five and buy one, all the way across. Parking arrangements, I don't know if we have time, we'll go through those. Those are more complicated, where we actually do take title to those properties. But most of the time, are going to be doing kind of the garden variety 1031 exchange. And that is called the delayed exchange, because you have 180 days to complete it. So that's a delay. If you see the chart, we're going to get involved in the money. We're going to assign onto that contract, temporarily become the seller, hold those funds, and then we're going to assign onto the purchase contract, momentarily become the buyer and use your funds. But the deed never passes through us. It's always going to go from you, the taxpayer, to your buyer, and then from the seller back to you, the taxpayer. So we're just going to keep the money out of your hands. In this whole exchange, we have 180 days. That's it. 180 days, calendar days. Okay. very few exceptions, really only one. So, and the first 45 of those calendar days is what we call the identification period. That's the only time that you have to identify properties. That's why you need good brokers to help you, because and do your homework even before you go into contract, because that 45 days of calendar days, if your 45th day ends on your birthday or Lobster Fest or Toyotathon or anything, it doesn't matter. The IRS doesn't care if it's a holiday. You have to have your identification by that day. And then you still have another 135 days to buy one or more of the properties that you've identified. So again, the time requirement is what makes the exchange challenging, but we do thousands of them, so it still works. So 45 calendar days from the day of closing is when you've got to give us, the QI, a list of the properties you want. You have 180 days total, but that can be shorter or longer in two reasons. It can be shorter if you closed last year and if you closed, let's say in December, and you haven't bought anything yet, you have actually until June, but if you didn't extend your taxes for your 2022 taxes, you would have cut off your tax date. So it can be shorter, but the only way you're going to get more time is if you or your property that's involved in exchange is in a federally declared disaster. So we've had a lot of those. There's been a lot of extensions, but that is the only thing that will give you an extension. Okay. So keep that in mind. It doesn't matter if the lender changes their mind or the seller does. That's why we have backup. So we've got identification rules. You get to identify up to 3 properties. If you sold your property for 900, you can identify one for $1 million or $2 million or $8 million or $950 or $840, whatever you want, as long as it's just 3. If you need to be buying multiple properties and you want to sell your property, say in California or Texas, and now you're going to go somewhere and just buy smaller houses that are less expensive, you might need 3 or 4 or 5 of them. So we have the 200% rule, and that says that if I sold my property for 900, I can identify as many properties as I want, but the value of them can't go over 1.8. Twice what I sold my property for. So for 900, 1.8 is twice. I can identify as many properties as I want, can't go over 1.8. The 95% rule isn't very popular. It doesn't happen very often, but if I identify too many properties and they go over the value, I have to buy 95% of the value of all those properties or I lose my exchange. So those are the identification rules, okay? We make sure that you follow those. And it isn't easy, but and when you can do 3 properties, you don't have to identify 3, but you get to. So one of them could be the one that you're under contract on, and maybe there's a backup, and maybe there's a backup to your backup. That's why we have 3. Identification rules, we have to have those rules made in writing. You have to unambiguously describe the property. You can't say something that I'm going to find in Texas, something with a great view in Maui. It's got to be 123 Main Street, Unit 7. Has to unambiguously describe it. These were written a long time ago in the 1990s. So they say hand delivered. We hardly see that. Mailed, of course. Telecopied, faxed, or otherwise sent. Most of the time, everything's going to be emailed to us. We're going to be very customer oriented and make sure that you have all the forms that you need to get that done and get it emailed. It has to be sent by midnight of the 45th day. Anytime after that, it's disqualified. And it has to be sent to the qualified intermediary or the title company. If you send it to AJ or your attorney or your accountant, they're disqualified because they're agents for you. Okay? Everyone asked me how they're going to know when you do something in the IRS. How will they know that you did an exchange? Did you drop out of a partnership? What did you do? And the answer is you're going to tell them on a quick 2-page form, and this is how you kind of solidify your exchange. You do all the paperwork with us. We have to make sure all the dates and everything are correct, and then you or your CPA is going to identify it on your taxes and use that form to kind of explain it. I went through that really quickly, but AJ, do you want to take it from here, or do we, and then leave it open for questions, or do we not?
Yeah. I'll take it from here. Thank you, Erin.
Okay. We'll get everybody out on time.
Yeah, exactly. First off, just everyone give a round of applause. Thank you, Erin. All that information is so helpful. We appreciate
That
your
was,
time. We're going to go over a couple properties now that are actually available in case anyone is looking to utilize a 1031 exchange. The first is going to be a brand new fourplex in San Antonio, Texas. This is actually the same builder that was building those brand new duplexes in Buda, Texas. Those same interest rate financing, the 4.25, 4.75% through CMG Mortgage and Reed Hazard is available for these as well. You just would have to get pre-qualified with them, and they would go over your finances and then discuss, the seller paid concessions that they have with those builders to get you that interest rate and go from there. But even this property, with only putting 30% down, getting that 5.25% rate, your monthly income is going to be $783 a month. That's with putting $315,000 down on $1 million brand new fourplex in San Antonio, Texas, with a builder called 210 Builders. We do a lot of deals with them. And then for your more, first time investor looking for just a good single family home investment, we do have 99 Cardinal Creek and a bunch of other single family homes out in Tennessee by a builder named Bill Mace with Bill Mace Homes. And these homes, same thing, you can get very lucrative financing with Reed Hazard. The next slide will actually have all the details on that. But this home, if we're able to get you the 5.25% financing that we can get with our builder relationships and putting 30% down, so about $100,000 down, you're going to be cash flowing over $200,000 a month just based off of your fixed expenses. And again, that's a brand new home with all the builder warranties included, managed by Marshall Reddick, free 6 months of property management, etc. So these are just a couple options. Again, I showed you a duplex, a fourplex, single family home, all brand new construction, all with 30% down, with our lucrative financing deals that are going to be in the positive cash flow, which is really just hard to find right now in this market with where interest rates are at. Here's the details on that financing sheet. If you want to take a screenshot of it or save it, you're more than welcome to. If you also go to the properties on our website, not the first photo will be a photo of the property, but the second photo, anything that's new construction with this financing, you'll be able to pull up this sheet and it'll have the specific financing options for each specific property. Again, we are a educated based company, so we like to educate all of our clients and investors and just people passing through on real estate. So you can always go on our website and you can actually click on the Learn tab on our website and you can watch any of our webinars. You can read any of our market data pamphlets. You can look at our property rating ebook, which I have right here. It's just a simple read, goes over A, B, C, D class properties, how we assign that classification to those properties based off of the median home price of the major metropolitan areas surrounding the suburbs that we're locating. And we also have all of our educational videos and articles and guides online under the Learn tab, as I mentioned before. Again, my name is AJ Bialik. I'm a real estate advisor here with Marshall Reddick Real Estate. I'm also a local realtor here in Orange County and LA County. I'm available for a complimentary consultation anytime. Here's my number at 949-889-2813. Here's my email address. Feel free to reach out anytime and we can go over your goals and any properties that you might own or properties that you're looking to buy and just see how we can help you accomplish those goals, etc. So thanks for joining us this evening. I look forward to talking to all of you here in the future and hope everyone has a great rest of their evening. Thanks so much. Bye.